Hello everybody. So in this video, what I'm trying to do is I wanted to address this GameStop situation, right? A lot of people are confused. Okay, you turn on the TV and all you hear about is GameStop this, GameStop that, hedge fund, short squeeze, and shorting, and stocks, and shares, and all kinds of stuff. Okay, and not everybody understands all this. But there's a lot of people that are so curious to know what is really going on. So what I'm gonna try to do in this video, and when everybody's reporting on this, they report it as though everybody understands really what's going on. Okay, so I decided to make this video so I can explain it to most of us who don't understand what's really going on in the simplest terms that you can understand, so you're not left out. Okay, so let's talk about GameStop. GameStop is a company. Okay, GameStop is a publicly traded company. There's two kinds of companies. Okay, you can have a private company like Cargill or Koch Industries. Okay, or Bloomberg. These companies are private companies, meaning they don't sell shares on the stock market. Okay, you can buy shares of Bloomberg or Cargill or Koch Industries. You can't do it. Okay, because they're private companies. And then you have companies that are publicly traded companies like Microsoft, like Google, like Facebook, like GameStop, and others, right? Those are publicly traded companies, meaning you can go on the stock market, okay, and find these companies and buy them just like you would walk in the supermarket and buy anything you want. Okay, that's why it's called a stock market. Okay, so in this case, GameStop, how did it end up being in the media, or what happened in this case? Okay, so retail investors and hedge funds and of course institutional investors who consider hedge funds and everything else invest in companies. What you want to do is that you can invest in a company hoping that it goes up, but you can also invest. I don't even know if we can call it investing. You can also bet on a company that that you want to make money when it goes down. Okay, so let me explain this. A stock, which of course shares, right? We're gonna call it a stock. Okay, a stock moves in three ways. Can move in three ways. Okay, it can move up, which we call long. Okay, and if you're betting that a stock is gonna go up, it means you're bullish. Why bullish? Because when a bull fights, it fights going up. So it's been considered every time when the stock is going up, it means it's bullish. So we say in as part of investing parlance, we call it bullish, right? And then a stock can go flat, sideways, right? Sideways. It's not moving up or down. It's just sideways. Okay, you can make money that way also. Okay, and you can make money when a stock moves down. Okay, when the stock moves down, you can make money, which we call shorting. Okay, going short. Okay, I'm gonna explain what shorting means, because shorting is what we're really talking about in this video, and this is what happened in this case. Okay, you had hedge funds shorting GameStop. Okay, and so that is when you go short or you bet that the stock is gonna go down, that is called bearish. Why do we call it bearish? Because bears is compared to a bear. Bears fight like this, right? They go down. So because they go down, we call that bearish. And so what happened to GameStop is, why would these hedge funds want to bet against a company going down? Why would you want to short? Okay, and so when a company stops making profit, or the revenues dwindle, okay, when they're on their way out of bankruptcy is pretty much ultimately what's going to happen. And fund I mean institutional investors, okay, are able to see this using models and everything else, and their calculations every time, every quarter when they have financial reports or reports there, they report the earnings to Wall Street. It's negative negatives. That tells everybody that the company is not doing well. So I can compare this to the jungle. Okay, when an animal is weak, okay, predators come in, they isolate the animal, and they're going for the kill. Okay, business is survival of the fittest. It's just like the jungle, only the strong survive. If a company is not innovating, it's gonna ultimately die. Okay, so with what innovation brings something with it, something we call creative destruction. Okay, meaning as you innovate, as companies create value for everybody else, for society, as we have better technology, as technology improves our lives. Okay, those old technologies, or those old business models die off. For instance, at one point, kerosene was it during the time of Rockefeller. Rockefeller made his fortune off of kerosene. Why? Because people used kerosene lamps for lighting at night. Okay, that was huge. Okay, in came in electricity. Well, we don't use much kerosene. Okay, we still use crude, but for other reasons, like the car. And what the car did, it decimated the horse business, which was used for transportation. Now we just go watch horses. We don't use them. We don't see horses on the highway. Okay, and so when new businesses come in, old ones die off. Okay, so with the advent of the internet has transformed our lives today. Okay, we shop online, we play online, we invest online. It's because of the internet that we have, an app like Robinhood that brought the market that was so foreign to a lot of people. Just investing itself, it was such an esoteric thing to a lot of people. Okay, it was for the elite, for those guys, and not us. So what Robinhood did, it brought investing to our homes, to our backyard, right in our bedrooms. Okay, the same thing that Netflix did. Okay, it brought videos to our homes, inside our living rooms. It's because of the internet. Okay, and so with that, with that improvement of, with that innovation, has come the destruction of certain business models. Okay, for instance, retail companies like Sears, companies like Jesse Penney, all retail, Barnes and Noble, have suffered from the advent of the internet and how Amazon has taken over, and Shopify stores, and online retail in a nutshell. Especially, it's been accelerated so much during the pandemic, where it used to be just a small percentage. Now I would like to think about 50% of all commerce, as far as retail, is done online shopping. Okay, so GameStop business model was brick and mortar, meaning people walked in the store and you bought your video games from there, and that was the business model, just like every other retailer, for the most part. And so when people have stopped going to those stores, the revenues have dwindled. Okay, now when revenues dwindle, hedge funds able to look at that company and say, you know what, it's about to go out. They smell blood in the water, like sharks. For those of you who've watched Shark Tank, or watch Shark Tank, the sharks can smell blood in the water. It means there's an opportunity to strike. Right? It's like a predator in the jungle. They're able to see and say, this animal is weak, so we're able to take it out. You know what I'm saying? And so they come in, and what they want to do is they want to short this stock. Okay, they want to short the stock so they can make money on this company's way out. Okay, so what is shorting? Let's talk about shorting now. There's a guy called Peter. Okay, so Peter sells phones, and I want to buy. I go to Peter, and I tell Peter, I say, Peter, I want to get this phone from you. I'll give it back. Okay, I'll give it back. So I would like to take your phone, whatever it is I want to do with the phone, whether I'm going to hold it or whatever it is. I'm going to get the phone, okay, and I'm going to give it back at some point. Okay, Peter might charge me whatever. Maybe it's $2 just to hold the phone. Whatever. He's gonna charge me some fee for holding on to his phone that I told him I was gonna give him back at a later time. Okay, so I take that phone, and what do? Because I know that somebody else wants that phone. There's the demand for this phone. I give it to somebody. Okay, somebody else. Let's say this phone costs $500. Okay, so I get the phone from Peter and I give it to somebody else. I sell it to somebody else for $500. I get the $500. And so what happens in this case is that I decide, you know what? Instead of giving Peter back his phone, because that was not my intention. I intended on selling that phone that I got from him. I want to buy that phone at a cheaper price. So what I do is that I wait. I wait because I think this phone is gonna go down in price, right? So as better phones maybe come along, you know, the price of this phone will go down, and that's what happens. Okay, when better phones come along, those phones that are old go down in price. So my plan is I'm gonna wait because I know for sure the price of this phone is gonna go down, and so I wait for the price to go down. When the price goes down, I go in and find John who's selling phones for $200. So I purchased that phone from John. Okay, mind you, I had $500. I sold the phone for $500. Now I'm gonna purchase it for $200. So I purchased the phone for $200, and I turn around and give Peter back his what? His phone, and I pocket the $300. That is shorting a stock. If I was going long on the stock, like most things, I would have bought the stock, let's say at two. You know, if I was just doing regular business, not before we get into the stock, I would have just gone to John. I believe the phone is I believe the phone is $200. I would have purchased the phone from John for $200, and I would have sold it to somebody else at $500. I'd made a profit of $300. That's how business is done. You know, for the most part, everywhere in the world, right? You know. And so, let's talk about Peter again. So here's the situation. So this model has worked for me because I go get, you know, I get phones from Peter, I sell them to other people, then I go and buy them from somewhere else once the price goes down because I know this model works and I've been doing this for years. So what happens this time around is that I do the same thing. I go to Peter. Peter, give me the phone. He gives me the phone. I find somebody to buy it. I sell it to them. They give me the money, the $500. And this time around, I'm looking for somebody that can sell me I'm hoping that the phone goes down. But what happens is that when I go looking for somebody to sell me the phone at $200, you know, I can't find anybody. I can't even find anybody to give me the phone for another phone for $500. Before I know it, the phone is selling at $600. Okay. Now, when the phone is selling, that was not the plan. The phone is selling at $600. Now, what I have to do is that I have to find $100 to put on top of the $500. Now it's costing me money. Okay, that is not the plan. So now if I don't purchase this phone at $600, it's gonna move to $700. Okay, it's gonna move to $800. Why? Because it's not only me who got the phone from. It's not only me who got the phone from Peter. There's other people that bought similar phones and are trying to give Peter back their phones. Okay, so if I don't give Peter back his phone when the price is at $600, somebody else will buy that phone for $600 and give Peter back. Now, since he bought, all of a sudden the price, since there's so much demand for these phones, because look, we realize these phones are going up, we all want to buy them at this price. And the more we get in trying to purchase these phones, the higher the price goes up of these phones. And now we're being squeezed out of our positions because we have to close our positions. Okay, we have whatever position we thought we had, we have to come up with the money and purchase those phones with our own money. Now we are running a loss. Our model has not worked. Okay, and so how does this relate to what happened with hedge fund? It's the same thing. So the Peter guy I talked about, that's the broker. Okay, the broker has all these shares. Okay, they make the deal. Okay, they transact and everything else. So the hedge funds these big guys go to the broker and say, Mr. Broker, I need several so and so amount of shares. So they borrow those shares. Okay, they get those shares and they sell it to regular people. Okay, mind you, their plan is that they want this company to go down. They know this company, the models and everything else has shown them that this company is on its last leg. They just need to go in for the spoils and get that money. The stock price is going to go down, and therefore they can borrow these shares, sell them to somebody else who's willing to purchase those shares right now for one reason or the other. You know what I'm saying? They're hoping that this company is they don't care what's gonna happen to those shares. They sell those shares to somebody else. Now they sit on this money. Okay, they sit on this money hoping that the stock price will go down. Okay, and when the stock price goes down, let's say they bought shares for $500. Again, they bought shares for $500. They're hoping for them to go down to $200 so they can purchase them at $200 and turn around and give them back to the broker and pocket the difference. So this has been going on for a long time. Okay, so what these guys did in the case of GameStop is that they bought more shares than that were not outstanding. Okay, 140% of the company was shorted. Okay, and so what that means is all these companies were hoping this company is gonna collapse, and once it does, they're gonna make a fortune like they always have. And in comes retail investors. Okay, a team of investors on Reddit.com in a forum, Wall Street Bets. They came together and said, "Listen, these guys have done this. They're hoping to make money off of this company. What we can do is we can go in and purchase these shares." Okay, mind you, remember I talked about the phones? They're looking for when you turn around and you're looking for phones to buy at a lower price and you can find them. They said, "Okay, we're gonna buy all the shares." We're going to buy all the shares, because when you buy shares, when there's demand for something, the price goes up. So when they went in and started buying these shares in this dying company, the price kept on going up and up and up and up. It's like my example. The phone now, you turn around and try to get those shares, at a low price. You don't find them because what? They have gone above the price you borrowed at, and now you have to cover. Okay, you have to cover your position. That's the short squeeze. You're being squeezed out of your position. Now, if you don't cover your position, you will lose money because now the stock is going against you. And when you short a stock, the risk is infinite. You can be wiped out. You know what I'm saying? You can be wiped out. When you short a stock, the risk is infinite. When you go long, you only lose. Let's say you go in long. You get into a stock at $500 and it goes down. The worst it can go is up to zero, right? You lose $500. Now, if you short a stock at $500, the stock can keep on going up to 1,000, up to 2,000. The loss is infinite. You don't want that. You can be wiped. Literally, you can be wiped out. And so the hedge funds realize this. They're about to be wiped out. So if they don't cover, they will lose everything. So they went in and started covering their position. Now, mind you, when you cover a position, you're buying. Okay, you're buying shares. So as the more they bought these shares, the more the price went up and 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 up until we ended up where we were from a $2 stock. Now GameStop is $400. It's reached $400 as of yesterday before it went down, and so that's really what's going on in this case. You have the little guy going in and buy shares, and the big guy is short squeezed out of their positions. They're so mad because nobody does that to them. It's the power of the internet that with creative destruction, like I talked about, okay, it upends business models. And right now, the hedge fund business model has been upended. They have to think twice before they short stocks, because Wall Street Bets is coming. We retail investors are coming. This is not the game they used to play back in the day where they owned everything. With the internet, we have the power in our own backyards, in our own living rooms, wherever you are. That's how much power. When people come together, you can't stop them. Okay, that's what's going on with GameStop. And at some point, GameStop is gonna go down. And actually, I have a short position, in GameStop, and the business model is not sustainable. It's going to go up and up and up, and at some point it's going to go down. And so when it goes down, we go in and we make money. Okay, we make money going up, we make money sideways, we make money going down. Anyway, guys, that's just that in a nutshell. I hope I've made you understand what's really going on with GameStop. If you like this video, please subscribe. And if you like more videos like this, I'll see you in the next video. Take care. Bye.